Welcome to Private Banking Strategies Podcast with Vance, Lowe, and Seth Hicks, your secret weapon to protect your assets and never have to start over financially again. Vance and Seth help high net worth individuals, families, business owners, and investors structure an asset-protected, tax-free fortress for their families. Learn how to keep what you earn and use the velocity of money to create your own private banking system. Join us on this journey as we explore the secret strategies of the rich and political elite and help you take total control of your financial security. Now, on to the show.
Hello, welcome to the Private Banking Strategies Podcast with Vance, Lowe, and Seth Hicks. This is a secret weapon to protect your assets and never have to start over again financially. Hey Vance, how you doing?
Hello. It's nice to see you again, Seth. And it's great to get back in the saddle and get another podcast for our listeners.
Likewise. Yeah, absolutely. It's exciting. I mean, we've got so much content to share with folks that it's always like trying to take a drink out of a fire hydrant, and us getting people information is always a joy. So today, I think we're going to talk about financial planning versus financial self-reliance. And it's something that people don't often consider, but something that they should, and understand the differences and the pros and the cons. Financial planning is not financial self-reliance, and private banking strategies is not financial planning or simply an investment strategy.
Yeah, that's right. In my former life, when I was doing financial planning, I thought I was independent and working for the client, when in fact, once my eyes were open to private banking, I realized that I was a puppet of government and banks under a strict format or a limited format. And that's why this came out. Not only myself, but past financial planners who moved over to the private banking discovered that there was a limitless possibility in self-financing, self-reliance, or whatever else. And so we'd like to go down a list and identify the two simply because you get all of these financial planning shows on the radio. We actually did one of those for about 2.5 years. It's very expensive. Everybody thinks that if you're on the radio, then you must be good. And that's might not be the case, Seth.
Right.
So yeah, let's go through this. We'll talk to the audience a little bit about the differences, get both of our points of view since we've got both a little bit of a different background. So Seth, why don't I start off with financial planning meets needs and goals only in a limited format. You take the information from a client and you build a format around what they can perform versus what is self-reliance? How would self-reliance take that and make the difference?
Yeah, well, I think with our strategies, it's pursuing wants and dreams, and it's more based on limitless ideas, what's possible, and what can you build a bank for your family to create, and what type of legacy can you create generation after generation. And in prior podcast, we've gone through illustrations that show legacy waterfall where death benefits flow from, let's call it a grandfather to a son or a grandson, and how those stack up. So very different in that aspect for sure.
Well, yeah, one of the things that really caught my eye in seeing that you don't have to be limited was the ability to get the money back, like banks. You know, we live around banks, do everything with banks. We try to take every advantage. We always complain that the banks aren't treating us right, which is correct, by the way. But the banks are doing something right that we or the public doesn't do. And I've got a theme that I've adopted here a last couple of weeks, Seth, and it's called we are switching people. We are teaching people and switching people from spending money to using money. And then we go in and we talk about what the difference is when people realize they can get the money back. And they can use that money over again, but get a brand new dollar's worth of product or services and then get the dollar back again, as well as getting new inflow of money from work. The whole world changes for them. And that's what this first one means. It's the possibilities open up for us, and it's evident. No one thought that they couldn't or they could live without spending principal. Everyone out there thinks I got to spend my principal in order to survive. As soon as we teach them, no, you don't, all of a sudden their eyes open up, they smile, and now there's a world out there in front of them. And all of us, you, me, everyone said, I sure wish I knew about this 10, 20, 30 years ago, but it's still not too late. So let's continue down this list a little bit, and we'll keep on talking and putting our 2 cents worth in. Minimizing requirements. How much do you have to save? So here we're looking for a protocol, maybe to replace a person's income. And so based on assets and everything else, what do I have to do from today on to when I retire so that I can replace my income? One of the things that we've got to understand and know is that retirement is a government socialistic myth. And nobody likes to hear that. The public out there feel entitled, that I'm entitled to retire and try to live comfortably. Well, we don't have any of that today. People are out of work. They are trying to spend down their nest egg. They're in all kinds of risky investments trying to make up this goal, this gap, and it's not working because they're not following correct principles. This is where this leads to, and it leads to, okay, we've got to invest money and put money at risk in order to reach your goals. So it's just based on what can you afford on a monthly basis to be able to do that. They're tying money up, they're putting money in accounts, and Seth, you and I have discovered that's putting money to sleep. In other words, we're handing money over to someone else and letting them make all the profits, and they pay us an interest rate as little as they can get away with. So what would be the counter to that? What did we find is much more lucrative than that, minimizing requirements?
Yeah, absolutely. I think that we talk about this, and it's one of the 7 pillars of private banking strategies is the velocity of money, putting it to work in an economy and getting a return and being able to use that dollar again and again, and optimizing those opportunities to effectively cycle your cash and have it growing inside your policy and also at work in an investment, and you've got some type of return on that investment. We've had various opportunities like oil and gas opportunities. We've had real estate opportunities. We've had private hard money lending opportunities. And I think when you are able to create that velocity of money, it's not a matter of saving or squirreling. It really shows you how you can expand your banking system and your banking value.
Another, I think, misleading, but what was focused on and what is focused on in financial planning is product-based investments. In other words, you need to get your money in one of these products, one of these investments, managed by someone else, managed by an expert, or this company or that company. And so you lose control of that money. You're hired a money manager or you've done this, and now they have that money and they're going to put it to work versus what? What's the next step here? Why is that not a good thing?
I think there's a lot of risk involved with that. Clearly, you've also got fees, you've also got no control. And most of our clients, and especially business owners and entrepreneurs, they want control of their cash and they want to be able to take the opportunities that come before them, not lock their money away in a prison, have liquidity, and have the ability to ultimately execute on the opportunities that come their way. And so using other people to make your investment decisions is giving away your control and doesn't always turn out well.
It doesn't. The SEC, the FINRA, and all these government organizations step in and want to monitor and control everything. One of the hideous things that people need to understand is there's a lot of good investments out there that cannot be presented to the everyday family because they're not sophisticated enough. That's really exactly what it means. These folks cannot make an educated decision whether they should be in this or not, so you can't show them this. And it's totally regulated. It's one of the things that was really discouraging for me to keep my ears and eyes open for something else so that we could have, or I could have an opportunity to, again, service clients, but in a much better and easier atmosphere. Seth, one of the things that we found out that goes to the strategy orientation versus buying products is we can put our own money to work and we can make the gains that they're making running their businesses or their portfolios or their hedge funds or whatever else. Let me give you a good example. If you bought out your remaining car payment, and because I did this, as we train the people, I go in and open up my books and show them exactly what I did. Over a lifetime, I spent over $500,000 buying new cars, way over $500,000. And working with the experts in the private banking field, I came up with a plan how to get that money back. But anyway, those loans were with Bank of America, and I think they were approximately 8.5% interest at the time. When they got down to 10,000, they were both coming down right at the same point. I bought the note, so I had to come up with $10,000. I was paying for my automobiles, each one $500 a month or $1,000 for the two vehicles. It was really, the payment was like $495, and I just rounded it to 500 because I like even numbers. And at 8.5%. So folks, here is an investment opportunity for a lending company. When they see they've got to come up with $10,000 to buy the debt, they can see that the payment is $500 a month, and they can see the interest is 8.5%. They're going to jump all over this opportunity. So, Seth, I'll put you on the hot seat for a little bit. Why are they so interested in that loan?
Because of the cash flow, the cash flow on the loan, servicing that debt. It's a consistent monetary flow. It's not interest rate driven. I mean, as a banker,
Well, wait a minute. Isn't it the interest rate? They're going to easily make 8.5%.
Well, that's not the total volume on the rate of return, as we both know, but it's the overall cash flow on that $10,000 outlay and what comes back to them over the term at $500 a month and 8% is a lot more than 8% on 10,000. And so it's cash flow, and it's the same thing that real estate investors look for, and the same thing that we talk about when people want to take out real estate debt. You've got a massive overall rate of return because of the cash flow.
So that's really important, folks. We've got to get off of chasing interest rates. Interest rates are out there for the common people to get off the mark. They chase interest rates and avoid looking at the real problem or the real money maker. Lending companies aren't in business just to make interest rate. Yeah, we're going to take it because it is a risk equalizer. But let's just do the numbers here, just see how lucrative this is. If I use $10,000 and I get a volume of return, that's $6,000 per year. If I were to divide my annual volume rate of return by my money at work, that's a 60% volume rate of return. Is that high enough?
Right. Right.
Then I asked, how long would you like it to last? It was about getting all the money back. And I stayed on that system for the first 10 of 20 years. I had a problem at 10 years because I ran out of debt to buy. And we all face that in this strategy. In 10 years with two vehicles, I got back my $500,000. That's all it took, because of the volume rate of return plus the velocity. When you control the money and when you put it to work, these are the returns you're going to get instead of the 8.5%. We're looking at opportunity cost loss. When we spend money, what is the opportunity that we could have put that money to work for the rest of our life? What would it have earned?
Did that story feel like it was about you? Do you feel like you are generating a lot of revenue, but are not moving forward as fast as you would like? Do you feel you should be making more progress toward your financial goals? Do you feel stuck? Let us help you get unstuck. Are you ready to take action and get your own private bank? Please visit us at www.privatebankingstrategies.com.
I used to show examples at kids. I used to do a lot of youth meetings and try to teach kids a little bit about money. And back in the day, you could go to a movie, get a pizza and a drink for $15. Now it's probably $30. I don't know. But I asked them and they came up with the numbers, and that's usually what they came up with. I said, do you have any idea if you took that $15 and put it to work for yourself at even 5% rate of return, what that would be at age 65? And people came up with a few numbers, okay? When they understood that was over $3,000 to $6,000, just that amount, how many of you gonna do a little bit of that? Pay yourself a little bit of this money. So it's the opportunity that we're looking for. We don't want to be limited. We need to have our assets. They need to be liquid so that we can go after that opportunity and capture the reward.
And I think that that's part of the, traditional financial planning that focuses on 401ks and IRAs and 403bs, which are ultimately locking your money up in a prison. You don't have access to it until you hit an age requirement, and then you have to take it out before you reach another age requirement, and you're going to pay taxes on it no matter when you take it out. And if you take it out before that sweet spot, after you've reached 59 and a half and before you're 74, you're going to pay a lot of penalties. So I think that also helps to focus, because if you go to traditional wealth management, they are, financial planners, they'll probably try to incorporate 401ks and 403bs and IRAs and talk about tax deferment. And you're not paying any taxes now, but we discuss this all the time. Would you rather pay taxes on the seed or the harvest?
I had a thought a little earlier I wanted just to share with people about retirement. The understanding of how to run your own private personal economy. Back in the day when this concept was in full swing in America, because we didn't have banks or branch banking, these life insurance contracts, and they would fund from there, self-finance back and forth. There's no such thing as retirement. Does any town have a retirement date? The answer is no. So you can't go out of production. It's what the banks want us to do, or government wants us to do. Number one, to keep control and to get what nest egg they haven't gotten yet. They want control of that money back. If you don't go out of production, we're seeing our clients who have a lifestyle change. I mean, there is a change. You're going to stop working from one thing and start doing what you want to do, hopefully. And you have X amount of dollars. And by the time you check off this planet, you'll probably have 3 times that amount. It won't be less. It'll be a lot more. And this is what, Seth, you were saying, that this is a perpetual plan. This is actually passed down from generation to generation. This is what the wealthy people do.
Exactly.
So, I think, like we're saying, the control, the institutional money is where people make the mistake. The herd mentality makes the huge mistake. Well, everybody's doing it, so it must be the right thing. My employer's going to do this. My employer's going to add X amount. Most people don't even add that up, by the way. They don't even understand that. They don't even add it up. They pour what they can into it. And yes, this is one thing that a lot of people won't do is save money. So they set up one of these controlled situations. It forces them to put money in, and now they're under the control of that institution and, on government option, and faced with all those restrictions. So they're worse off than they were before. In over 40 years, I've never had a client or a person, when I ask, do you think you're going to be in a lower tax bracket when you retire? Always higher. Okay. And why are you doing the 401k? Here's the thing, Seth, and it's funny. People would much rather fail financially with company than succeed alone. Now it's a proven fact. It blows me away, but they're more comfortable with their friends about failing. But we're failing together, so everything's okay, rather than succeeding alone. The next thing, and everybody was big on this, I think it's still big today, it's called macro or vacuum-based planning. It's portfolio planning, where they go in and they set up a wheel, so to speak, and say, okay, you got so much here, you got so much here, you got so much here. And a lot of them are opposites, but they're all investments with someone else. You've got to buy their stock, mutual fund, bond, whatever it is, and somebody's managing that portfolio. Well, this one is good now, that one's not so good, this one's not so good. Seth, I think we need to tell them, when you have a portfolio with a stockbroker or everything else, you've got to ask the correct questions. So we've got to let you know, everybody knows Warren Buffett. The guy just is Midas touch. Everything he touches almost turns to gold because he does it correctly. He knows more about the company he's going to invest in than the company does itself, because he can tell that company where it's going to be in 10 years. They can't. The CFO, the CEO, the president, all the financial gurus come in, and he has a meeting with them, and he sits down and says, we want to do some investing because we think your company is going to go here. You've got this, we can leverage this and take it here. And he stops and he pauses and he says, every time, everyone's jaw is wide open. Where did you get this information? How do you know about this? Well, I did my homework. What everybody does is they look at the average rate of return, and that's fictitious. Let me give you a good example here. If I was a money manager for you and you gave me $100,000 to manage, the first year I double it. In year 2, I lose 50%. In year 3, I gain 25%. In year 4, I lose 12.5%. At the end of 4 years, now this is probably unfair to everybody, how much is in your account? Right. If you're a good math wizard, you're going to be very close to $100,000. But
Right.
guess what I legally get to put in the prospectus for that 4 years? That fund averaged a 25% annual rate of return, because mathematically that's the number that comes up. And people will invest in that all day long, but they ask the wrong question. The correct question to ask, folks, and this will really throw your brokers in a tizzy, ask, what is the yield on this account? Yield means money put in the account that cannot be returned, that can't reverse it, cannot be reversed. Banks were very big at the beginning on yield, especially savings accounts. Everything's in your account and nothing can be taken out of your account. Life insurance is that way. It's all based on yield. Okay. Right. Everything all the profits, they could have a big profit one year and a loss the next year. Nothing comes out of your account. Everything's there. All the guarantees are there. So yield is important, because if you would have asked me, what's the yield on that 4 years? I would have had to say 0. Now, how likely are you going to be to buy that investment? Yeah. You can do that with stocks, bonds, mutual funds. They're going to tell you can't. Well, we don't have any of that information. Well, then why would I want to make a decision on false information, on a mathematical number that doesn't equate to what I'm actually going to get? That's one of the biggest faults and problems with financial planning.
Right.
So what's the counter to that, Seth?
Well, I think viewing the big picture and looking at your whole personal economy and focusing on yield, obviously, with your investments and where you've got your money at work. Also, there's elements of keeping control, having, the decision-making power, at being smart with your own decisions. But that's kind of a tangent, but I think it's basically looking at a big picture rather than
small picture, right?
Small picture.
So here, the first thing I saw on this topic was I now own the debt. I woke up my money and I actually bought my debt. I bought my mortgages. I bought my automobiles. I bought everything I possibly could, my other companies. And now I'm receiving all that third party profit is coming into me. But guess what, Seth? And folks, it's totally tax free. All the money I got back for my automobiles, that $500,000, totally income tax free. Talk about a macro picture. This is wide open. You open this up to your extended family. Hey, we got a family bank. We're going to self-finance. We're going to charge a good interest rate. Interest rate's going to be turned around, and it's just going to multiply like crazy. So good difference between micro and macro.
Rather than managing or measuring in total portfolio value and creating bigger portfolios, it's more about cash flow is the measurement, especially when you're buying debt. And you've got cash flow streaming back into your banking system. Like you had mentioned, the more debt that you purchased on automobiles and real estate, the more cash flow you've got coming into your banking system. That's really the measurement.
When I started this, I received the training from the very best people out there. R. Nelson Nash himself really tutored me on this concept. So I immediately sold my company and received quite a bit of money. And Nelson Nash, in his books and everything else, set up a process of funding your bank, funding your company, your lending company first, so it's profitable, and then start the money process coming out. Well, I figured right off the bat, if we used what's called a paid up additions rider, we could go back or do a big portion in single premium, which is cash valuable immediately, and I could start banking almost on day one. But I had all this cash back in my control. I was worried where I was going to put it. So I decided right now my monthly overhead for all my stuff back then, 20 years ago, was $10,000 a month. I could buy that debt, but did I want to wait 5 years to get that into my life insurance policy? So the math at $10,000 a month is $120,000 a year times 5. That's $600,000. Right. I don't think I could make that up had I waited. So I bought the debt and I reversed the cash flow of $10,000 to inflow. That's right. Literally a $20,000 difference from depletion to addition every month, folks. That's what we're talking about here.
Yeah, and Nelson describes that in his book with regards to drag versus lift, right? Or maybe he didn't describe it in his book, but he certainly taught the principle of an airplane heading into a headwind, which creates a drag or a shear down. And that's what that $10,000 going out and you losing control of it and you losing the ability to put it to work versus buying the debt, having that 10,000 coming in and creating lift and a tailwind that accelerates your wealth curve.
That's beautifully said, guys. Yeah, if any listeners out here haven't ever read Nelson Nash's book, Becoming Your Own Banker, you need to.
Absolutely, yeah. So, I mean, I think it definitely clarifies the difference between a financial planning paradigm and what we do at Private Banking Strategies. And if folks want to learn more, you can find us at www.privatebankingstrategies.com. That's privatebankingstrategies.com. And on our website, you'll be offered a free book that Vance and I wrote entitled What the Banks Don't Want You to Know. And that book highlights some of these issues and many more that act as a red pill to folks who are new to these ideas and these concepts. And also, we've got all of our podcasts there on the website that you can listen to for free. There's content on every type of subject matter that you could want to understand with private banking strategies. We've got other resources and materials and articles. And if you've done that, if you've read some of the emails that we send and these things are resonating with you, you've listened to some podcasts, you can schedule an exploratory call with Vance and ultimately create an 8-year plan to see how private banking strategies will work, particularly for you and your family. So that's our roadmap. That's our process.
Did that story feel like it was about you? Do you feel you should be making more progress toward your financial goals? Do you feel stuck? Let us help you get unstuck. Are you ready to take action and get your own private bank? Please visit us at www.privatebankingstrategies.com.
Thank you for listening to the Private Banking Strategies podcast. Click the subscribe button below to be notified when new episodes become available.